Prologue. Where is the crypto market really headed? In 2021, South Korea once again found itself swept up in a wave of cryptocurrency mania, just like it did in 2017. From subway riders checking Bitcoin prices on their phones, to overheated customer service lines at exchanges, crypto fever was everywhere. Whether you stepped into a cafe, a convenience store, or even a bar, it wasn't unusual to overhear someone talking about their crypto gains. Just as real estate and stocks had previously turned everyday people into millionaires, now crypto had entered the race, and it was moving fast. In fact, nowhere else in the world did crypto draw such intense interest as it did in Korea. The term kimchi premium was even coined to describe how much higher coin prices were on Korean exchanges compared to global. On's an indicator of how eager local investors were to get in. Interestingly, while the international market was already booming, the Korean crypto scene often moved even faster. Investments poured in, not just from experienced traders, but from complete beginners chasing quick riches. It was more than a trend, it became a cultural phenomenon. So what made this happen? Why did the crypto market capture the attention and money of so many Koreans? Experts say there are three major reasons behind this explosive growth. Why did the crypto boom explode in Korea? There are three main reasons experts point to when explaining why cryptocurrency became such a powerful force in South Korea. First, the crypto market offers something traditional. Financial markets rarely do limitless price movement. In the Korean stock market, price fluctuations are usually capped at 30% per day. But in crypto, anything goes. A coin could double overnight or crash just as fast. For many, this volatility wasn't a risk, but an opportunity. Some investors dreamed of becoming rich overnight. They saw crypto as a shortcut to wealth that didn't require long years of saving. From small forums to bustling cafes, from YouTube to Telegram groups, people chased the dream of quick profits, swept up in a 247 roller coaster of price surges and dips. Second, Korea's fast-paced, trend-sensitive culture played a major role. In a country where trends spread like wildfire, the rise of easy-access investment culture through platforms like YouTube and social media made investing feel approachable, even exciting. As the economy grew and more people entered the middle class, public perception of investing began to shift. It wasn't just about saving anymore. People began exploring stocks, real estate, and eventually, crypto. Following friends into the market, jumping on trends, or just wanting to try something new became common, especially among young adults. Third, the COVID-19 pandemic accelerated it all. When global lockdowns froze supply chains and shut down economies, traditional markets stalled, but instead of retreating, many investors doubled down, hoping for a fast recovery and fearing they might miss out on the next big wave. Governments all over the world pumped money into the economy to soften the blow of the pandemic. In Korea, that extra liquidity flowed directly into investment assets including crypto. Low interest rates, rising home prices, and frustration with limited upward mobility all fueled what became a perfect storm. By April 2021, Korea's top 4 crypto exchanges were flooded with new users. The level of retail participation in crypto trading had reached an all-time high, bordering on a national obsession. Why did a major crypto exchange publish a guide for everyday investors? Back in early 2014, when Bitcoin was still something only tech-savvy pioneers talked about, there weren't many places for the average person to buy or sell crypto. That's when a group of early movers, some from finance, others from tech, jumped in to create Korea's first major cryptocurrency exchanges. Among them were employees who would go on to work at some of Korea's top crypto platforms. They had a front row seat to everything: the meteoric rise of Bitcoin, The explosion of altcoins and the emotional rollercoaster that followed. Over 8 years, they watched the market evolve. Rapidly, sometimes too rapidly for the average investor to keep up. As crypto became more mainstream, the wave of new participants brought a new problem. Many of them didn't understand what they were investing in. They followed trends, chased hype, and relied on rumors rather than research. While some were lucky, others weren't. Many people invested their life savings into digital assets, without fully grasping the risks. And when markets crashed, the consequences were devastating. It wasn't just a financial issue, it was a moral one too. Watching this unfold, industry veterans began to feel a deep sense of responsibility. They realized that the gap between investor interest and investor knowledge was dangerously wide. Studies from local research institutions confirmed their concerns. A growing number of investors were making decisions without proper information, falling into categories like uninformed, noise traders, or irrational investors. That's why, rather than sit back, one exchange decided to act. They gathered a team of experts across multiple fields and began building a guide not for traders, but for everyday people just beginning their crypto journey. Why did a major exchange publish a crypto guide for the masses? Continued, they couldn't just stand by anymore. Seeing too many retail investors suffer realism, losing their entire savings sparked a sense of duty among those in the industry. According to market research, a significant portion of retail investors were operating without proper knowledge or strategy. They were classified as uninformed, noise traders, or even irrational actors. It was clear something had to be done. That's why the exchange assembled a special task force. They handpicked 11 team members, each with expertise in a different field, to help build a guide that could close the knowledge gap and make crypto safer for everyone.
How should we view the current crypto market? The crypto market has gone through numerous ups and downs over the past several years. While 2017 was defined by wild speculation and unregulated hype, the current market environment looks very different. There is now a growing consensus within the industry that maturity is gradually being achieved. One of the most notable changes is the rise of regulations. Governments and financial authorities in various countries are starting to introduce legal frameworks for cryptocurrencies. These include tax policies, anti-money laundering guidelines, and registration requirements for exchanges. While some see regulation as a burden, others view it as a necessary step to protect investors and bring long-term stability. Importantly, the market today is no longer dominated solely by retail investors. Since the bull run of 2021, institutional investors have entered the space with increasing confidence. Large asset managers, hedge funds, and even banks are showing interest in digital assets. This influx of professional capital has added a layer of credibility to the market. Moreover, blockchain technology itself is evolving. Beyond just trading coins, developers are creating more scalable, secure, and user-friendly platforms. The rise of decentralized finance, DeFi, non-fungible tokens, NFTs, and tokenized real-world assets suggests that blockchain has real-world utility beyond speculation. Despite occasional downturns, the market today is far more stable and structured than in previous years. The emotional roller coaster of the past is giving way to a more rational and regulated ecosystem. For investors, this may mean fewer dramatic spikes but also fewer devastating crashes. The foundation of optimism in the crypto market. The optimism surrounding the crypto market isn't just speculative, it's supported by real changes in the global economy. Major tech companies and financial institutions are gradually integrating cryptocurrencies into their systems. From payment processing to wealth storage, blockchain is becoming more than a buzzword. In 2020, companies like PayPal and Square began to allow users to buy, hold, and pay with Bitcoin. Even Facebook, despite regulatory setbacks, attempted to launch its own cryptocurrency project. These moves signal a broader shift. Digital assets are being recognized as serious financial tools, not just fringe technologies. Meanwhile, South Korea's Kakao and other tech giants in Asia are building their own blockchain-based ecosystems. Across the globe, decentralized platforms are rising, challenging traditional financial structures. As with any technological disruption, growing pains are inevitable. The road to innovation is often littered with regulatory hurdles and economic uncertainty. But within that chaos, new possibilities emerge. The breakdown of old systems often signals the birth of something new. The smart investor prepares. So, how should individual investors respond to this changing landscape? The answer lies not in hype or fear, but in preparation. A well-informed investor who studies trends and adapts to new environments stands a far better chance of long-term success. Market history has shown this repeatedly. Whether it was the explosive growth of the Korean stock market in the 1980s or the dot-com boom of the 1990s, those who survived and thrived were the ones who combined curiosity with caution. Success comes to those who prepare. In every market cycle, noise and speculation dominate the headlines. While some chase hype and rumors, the wise quietly prepare for the moment when the market turns in their favor. True opportunity does not come with a loud announcement. It arrives when most people are distracted or discouraged. The difference between those who thrive and those who miss out lies in preparation. It's not about predicting every move, but about being ready when the time comes. Downturns are not the end. They are windows through which the prepared can enter. Smart investors don't rely on luck or shortcuts. Instead, they focus on understanding the market, studying trends, and refining their strategies. Rather than looking for ways to make easy money, they concentrate on building a solid foundation so that their efforts eventually bear fruit. This book was written to help such investors, those who seek to approach the crypto market with clarity and discipline. It aims to provide a roadmap, guiding readers through essential economic principles, market strategies, and legal frameworks. Behind this work lies the effort of many contributors, from financial analysts to legal experts, who helped ensure that the information presented here is accurate, practical, and easy to understand. To them, and to the readers taking their first step into the world of crypto investment, this book extends its deepest gratitude. It is our hope that this book becomes the first and most reliable guide for anyone looking to enter the world of crypto investing with confidence.
Minor altcoins and the evolution of blockchain generations. Within the vast landscape of cryptocurrencies, minor altcoins represent the long tail of the market. These are often lesser-known tokens with lower market capitalization, limited liquidity, and smaller communities. As a result, they may be more volatile and harder to trade in large volumes. One feature commonly associated with minor altcoins is the presence of lockup periods. These are preset schedules that prevent early investors or team members from selling large amounts of tokens immediately after launch. Lockups are designed to prevent market flooding, stabilize prices, and align long-term incentives, but they can also influence token prices. Once the locked tokens are gradually released into the market. As the crypto industry has matured, blockchain technologies have been categorized into three broad generations, each defined by its core innovation. First generation, represented by Bitcoin. This generation introduced the concept of decentralized digital money through blockchain. Second generation, with Ethereum, the focus shifted to smart contracts, programmable agreements that enabled the creation of decentralized applications, DApps. Third generation, these projects aim to overcome the limitations of earlier blockchains, including scalability, interoperability, and governance. Examples include Polkadot, Cosmos Atom, Tezos, XTZ, Terra Luna, and Clayton Clay. This classification is not about ranking one project over another. Rather, it reflects the technological milestones that have shaped the evolution of blockchain. Each generation marked a leap forward in how decentralized systems can transform industries and societies. The tiny coin that caught everyone's attention, CBDC. As Bitcoin began rising like a rocket, shaking up the global financial world, the central banks of the world quietly started having meetings of their own. Behind closed doors, they weren't asking, "How do we stop this?" They were asking, should we make our own? And so, the idea of CBDC central bank digital currency was born. Imagine your regular national currency, but fully digital, traceable, and issued directly by your country's central bank. No paper, no coins, just a clean string of digits. Controlled at the highest level. Unlike Bitcoin, which operates independently of any government, CBDCs are designed to maintain control, not remove it. They're meant to modernize the existing system, not overthrow it. In a way, they are the government's answer to the rise of crypto. Now here's where it gets interesting. As of 2021, dozens of countries had jumped onto the CBDC train. Let's take a quick tour. Bahamas led the charge with the world's first official CBDC, the Sand Dollar. Cambodia and Brazil followed with early versions of their own. China was already running trials in major cities, and they even plan to use it during the 2022 Winter Olympics. The EU, Japan, Russia, Sweden, and the UK were all launching test programs or forming task forces with fancy names. Meanwhile, the US and South Korea were still building infrastructure and running simulations to see how it might work. Oh, and Venezuela? They actually launched one called the Petro, but let's just say it didn't exactly become a global standard. What started as a futuristic idea quickly became a geopolitical race. Not every CBDC will succeed. Some might never even launch. But the message is clear: the future of money is going digital, and nobody wants to be left behind. The hidden risks behind CBDCs. At first glance, CBDCs seem like the ultimate solution, a sleek, digital version of money that's traceable, secure, and cost-effective. Central banks could cut down on printing costs, track illicit transactions, and respond to economic changes faster than ever before. In fact, in 2019 alone, South Korea reportedly spent nearly $90 billion just to print and manage physical currency. Imagine saving all that by going fully digital. But not everything about CBDCs is shiny and simple. As crypto adoption grew, so did skepticism. The public watched token prices skyrocket, then crash. Some began to wonder, are these just risky assets wrapped in tech jargon? Can CBDCs really be trusted? Or are they just another centralized tool dressed in decentralized clothing? The answer lies in how they're used. When backed by strong legal frameworks, blockchain-based CBDCs can offer transparency and efficiency. Every transaction can be recorded and verified, reducing fraud and boosting accountability. But there's a darker side too. What happens if a CBDC system gets hacked? If a critical vulnerability allows data to be tampered with or stolen? The consequences won't just affect one person, they could disrupt entire national economies. And then there's the hyperinflation concern. If CBDCs are mismanaged or used to inject
the mystery of the kimchi premium. If you've ever tracked Bitcoin prices across different countries, you might have noticed something curious sometimes. The price in South Korea is noticeably higher than in other parts of the world. This phenomenon has a name: the kimchi premium. It refers to the price gap that occasionally forms between South Korean crypto exchanges and their international counterparts. But why does this happen? Several factors play a role. First, South Korea has strict capital controls, meaning it's not easy for investors to freely move large amounts of money across borders. That makes it harder for arbitrage traders to quickly buy low abroad and sell high in Korea, which in turn allows price gaps to persist longer. Second, there's huge demand from Korean investors, especially during bull markets. When FOMO, fear of missing out, kicks in, retail traders rush in, driving up local prices. Combine that with regulatory uncertainty, limited institutional access, and language barriers that limit foreign competition, and you get the perfect environment for a pricing bubble. In some cases, the premium has reached double digits, meaning Korean investors were paying 10% or more above global market prices for the same coin. And according to Bloomberg, this isn't likely to disappear anytime soon, with major global exchanges like Coinbase gaining influence and connecting more traders around the world. Korean exchanges are also becoming more intertwined with global markets, but the premium still lingers. For investors, it's a reminder price isn't always universal in crypto. Where you buy can be just as important as what you buy. Inside the crypto exchange, what does market really mean? When you enter a crypto exchange, it might feel like stepping into a foreign marketplace. Theory are signs everywhere. Dozens of coins and multiple markets listed. But what do these markets actually represent? In simple terms, each market is based on a quote. Currency you use to buy another crypto. Think of it as the currency you're paying with. In South Korea, for example, many exchanges operate a KRW market, where users can buy coins directly with Korean won. Internationally, however, things are a bit different. Most global exchanges operate markets based on BTC, ETH, or USDT stablecoin that's pegged to the US dollar. So if you're on an exchange that offers a BTC market, that means Bitcoin is the base currency wanted by Ripple XRP. In that market, you'll need to first have BTC in your wallet. This brings us to stablecoins, a crucial part of crypto trading. Stablecoins like USDT, USDC, or BUSD are designed to maintain a 11 value with fiat currencies like the US dollar. They act as a bridge between traditional money and crypto assets, offering stability in an otherwise volatile environment. On many exchanges, USDT markets are the most active and widely used. When you trade in a specific market, all transaction fees are also calculated in that market's quote currency, so knowing which market you're in isn't just helpful, it's essential. The takeaway: understanding markets and quote currencies helps you avoid confusion, optimize fees, and navigate exchanges like a pro.
What is crypto mining? A fun story time explanation. So, you've heard people say they mine Bitcoin, right? Sounds like they're digging up gold in some secret digital cave. Well, in a way they kind of are. Imagine this: every time someone makes a cryptocurrency transaction, like sending Bitcoin to a friend, someone needs to record that action and make sure it's legit. That's where the miners come in. But don't picture pickaxes and helmets. These miners are using powerful computers to solve super tricky puzzles. Why puzzles? Because in the world of blockchain, you can't just say, "Hey, I sent 1 Bitcoin." The system needs proof. So the miners race against each other, trying to solve a complex math problem. The first one to solve it gets to add the new transaction to the chain, like adding a new page to a diary, and as a reward, they earn some brand new digital coins. This whole process of verifying, solving, and recording is what we call mining. So next time you hear crypto mining, don't imagine dusty tunnels. Picture a high-stakes puzzle game happening at lightning speed across the internet, and the prize? Digital gold. What is an airdrop? A crypto surprise party. Imagine waking up one morning and boom, you find free crypto in your wallet. No scam, no strings attached, just a surprise gift. That's an airdrop. In the crypto world, an airdrop is when you get free coins or tokens simply because you already own a certain cryptocurrency. It's kind of like getting company shares just for being a loyal customer. But why would anyone give away free digital money? Well, think of it like a marketing stunt. When a new project launches or goes through a major update, like a hard fork, which is basically a software upgrade that splits a blockchain, he might send out free coins to create buzz and build a loyal user base. It's like handing out free samples at a store opening. And here's the fun part: people tend to value things more when they already own them. It's a psychological trick called the endowment effect. So once someone gets a free token, they're more likely to care about the project behind it. This strategy helps projects grow their community, spread awareness, and even control their future coin price by increasing distribution among real users. So next time you get an airdrop, remember you are not just getting free crypto, you're becoming part of a bigger network, and maybe, just maybe, a secret crypto club. snapshots, token swaps, and forks. Crypto's plot twists. Let's say you're holding some crypto coins in your wallet, just minding your business. Then one day, bam, you hear there's going to be an airdrop. But how do they decide who gets the free tokens? Enter the snapshot. A snapshot is like a freeze frame of the blockchain. It records who owns what at a specific moment in time. So if you're holding a certain coin at the snapshot moment, you're in luck, you might get free tokens later. It's kind of like taking attendance in class, except your reward might be digital gold. Next up, token swaps. Imagine your favorite crypto project is moving to a new, a whole new blockchain. That's what we call a token swap. You trade your old tokens for new ones on the new network, usually at an 11 ratio. It's like swapping out old arcade tokens. When the arcade upgrades their machines, same value, just a better system. And then, the drama forks. In crypto, a fork happens when developers decide to change the rules. A soft fork is like a software update. It keeps the old rules mostly intact, just tightens things up. But a hard fork? That's a full-blown split in the road. The old chain goes one way, and the new chain starts fresh. Sometimes, this even creates an entirely new cryptocurrency. So whether it's snapshots, swaps, or forks, just remember the crypto world is full of surprises, upgrades, and sometimes, a bit of drama. Forks, nodes, and the drama of splitting blockchains. So picture this: a group of developers decides it's time for change. Maybe they want to improve security, add new features, or just shake things up. That's when we get a fork in the blockchain. A soft fork is like updating the rules in a game, but still letting the old players join in. It's backward compatible, meaning even if someone hasn't updated their software, they can still play along. It's a gentle kind of change, optional, and usually agreed upon by most people in the network. But then there's the hard fork. That's when things get real. A hard fork is like a massive disagreement in the community. The update is so big that the old and new versions of the blockchain can't work together anymore. They split and a whole new coin is born. Imagine Bitcoin suddenly giving birth to a new sibling like Bitcoin Cash BCH or Bitcoin Gold BTG. That's a hard fork in action. But beware, the chaos doesn't end there. If you try to move your crypto after a fork without being careful, you might fall into a trap called a replay attack. That's when your funds accidentally get copied and sent on both the old and new chains. Ouch! So always double check before sending coins post-fork. And who makes all this possible? Nodes are the computers that connect to the blockchain network and keep everything running. They're like the servers of the crypto world, and anyone can be one. In the end, forks are how blockchains evolve. Sometimes it's peaceful, sometimes it's a digital divorce. How crypto trading works on an exchange the Bithumb way. Let's say you're ready to buy some crypto. You log into an exchange like Bithumb and you're staring at all these numbers. Don't panic. There's a system in place to keep everything safe and fair. Bithumb, like many exchanges, doesn't let you enter any wild price you want. When you place a buy or sell order, there are price limits. For example, you can't set your price more than 300% above, or 90% below the current market rate. This prevents accidental fat finger trading and protects users from sudden, extreme price swings.
Crypto trading tips: price steps, minimum orders, and how limit orders work. Okay, so you've decided to buy some crypto, but here's the thing: you can't just throw in any random number and hit buy. Most exchanges have a few rules to keep things smooth, especially when it comes to pricing and order sizes. First up, price steps, or what they call tick size. Depending on the price range of a coin, the smallest amount your bid or ask can change is automatically adjusted. If a coin is super cheap, say under 1 won, The smallest step might be just 0.00011, but for a coin's worth millions, that step could be 1001 or more. It's like rounding to smarter. Next, minimum order amounts also scale based on price, so you can't flood the system with micro orders that barely move the needle. This helps keep the market clean and efficient. Now let's talk about limit orders, or what they call Chichen. This is where you choose your own adventure. You set the price you want to buy or sell at. If the market hits your target, boom, the trade happens. If not, your order just waits quietly in the pending orders list, until it finds a match. And here's a pro tip: if your buy price is higher than the current market, or your sell price is lower, your limit order might get filled instantly just like a market order. So even though you're choosing your price, you can still get immediate results if your offer is good enough. Limit versus market orders, what's the difference? Alright, so you picked your crypto and you're ready to buy or sell, but now the exchange asks limit order or market order. Don't worry, it's not as confusing as it sounds. Let's start with the limit order. With a limit order, you're the boss. You decide the exact price you want to buy or sell at. Let's say you want to buy Bitcoin, but only if the price drops to 45 million won. You set that as your limit, and your order sits and waits. If the market reaches that price, bam, your trade goes through. If not, your order just chills in the pending list until further notice. Now, the market order. This one's all about speed. Instead of waiting for your target price, a market order buys or sells immediately at the best available price. It's like saying, just get it done. This is great if the market's moving fast, and you don't want to miss out, but be aware, you might not get the best possible deal. Exchanges like Bithome often let you adjust how much of your balance you want to use: 25%, 50%, 75%, or 100%, and you can set up to 10 items at once, which is handy if you're managing a big portfolio. Bottom line, use limit orders when you want control. Use market orders when you want speed. Stop limit orders, your crypto safety net. Let's say you're watching a coin's price dance up and down, like a roller coaster. You don't want to buy right now, but you also don't want to miss the perfect entry point. Or maybe you're holding a coin and want to sell it before it crashes. This is where stop limit orders come in through your crypto safety net. Here's how it works. You set two prices. The stop price is your trigger. The limit price is your target. Think of the stop price as the alarm bell. When the market hits that level, your limit order gets activated like flipping a switch. Then your order tries to execute at the limit price you chose or better. Example 1: automatic buy. Let's say you believe if a coin breaks above 10,001, it'll keep going up. You set a stop at 10,000 and a buy limit at 10,100. If the price hits 10,000, your order goes live and it'll buy as long as the price stays within your range. Example 2: automatic sell. Now imagine the opposite. You want to protect your profit. You bought a coin at 9,001, and it's now at 11,000. You set a stop at 10,000 and a sell limit at 9,900. If the price drops to 10,000, your order activates and sells before things fall further. But here's the catch: a stop limit order isn't guaranteed. If the market moves too fast, your order might not fill, so it's smart to set your limit price wisely. In short, stop limit orders help you plan ahead so you're not panic trading in the heat of the moment. Set it, forget it, and let the system work for you. Chapter: check your crypto performance like a pro. Narration begins. Once you've started trading crypto, it's easy to get caught up in the thrill of buying, selling, and watching prices move. But here's a question many beginners forget to ask: am I actually making a profit? The answer isn't always obvious, especially when you've got multiple coins, different entry prices, fees, and market fluctuations all happening at once. That's why checking your trading history and asset overview regularly is crucial. Most exchanges provide a section where you can see all your past actions, which coins you bought, how many, at what price, and even whether the order was fully filled or partially matched. There's also your wallet balance screen. This is where the real story lies. It shows your total assets, average buy price, total invested amount, and your current profit or loss, auto-calculated using the current market price. Here's a simple formula you can remember. Total assets, sum of current value of all your holdings minus fees. Total buy amount, how much you actually spent. Profit loss, current value by amount. Everything updates in real time, so as the price of your crypto rises or falls, your return rate shifts accordingly. Think of it like your crypto report card. And if you want to grow as a trader, don't just look at the charts, look at yourself too. Chapter: how to know if you're really making money and save on fees. Narration begins. Now, let's talk numbers. You bought some crypto, watched it go up and down, and maybe even made a few trades. But how do you actually calculate your real gains? It's simpler than you think. Here's a basic formula: profit rate % total profit total invested times 100, profit current value total amount you bought, current value your holdings times current market price, buy amount your holdings times average buy price. It's like keeping a journal for your money. Every coin tells a story, and the numbers don't lie. But there's one thing that eats into your profits silently: fees. Most exchanges, like Bithumb, charge a fee between 0.04% and 0.25% per trade. It may seem small, but it adds up fast, especially for frequent traders. Here's the good news: you can cut down those fees using something called a fee discount coupon. You can buy these coupons directly on the exchange, sometimes up to 100 at a time, and they're valid for around 60 days. Once applied, they reduce your trading fees instantly, and can even refund part of your costs, depending on the market, like BTC or KRW. But heads up, if you already have an old coupon active, new ones will get used after the first one runs out, so be smart, plan your trades, and stack those savings. Crypto trading isn't just about timing the market, it's about managing your strategy and your fees. Chapter: Getting your crypto cash in and out safely. Narration begins. You've picked your coins, you're ready to trade, but wait, how do you even get money into the exchange? That's where deposit and withdrawal accounts come in. On exchanges like Bithumb, you need to open a real name, verified bank account that's connected to the exchange. It's not just for security, it's also the law. In Bithumb's case, they work within each non-GAAP bank. Once you've created the account, here's the process. 1. Sign up on the exchange. 2. Create a linked bank account at the partner bank. 3. Verify your identity, both online and offline. 4. Get your unique deposit code through the Bithumb system. 5. Connect your account and you're ready to go. This whole flow makes sure that no one else can touch your funds. And if something goes wrong, like your name doesn't match or your account isn't verified, you'll have to fix that before the system lets you deposit or withdraw anything. Now, let's talk perks. Bithumb offers fee discounts. Here's depending on how much you trade. The more you use the platform, the higher your grade, and the bigger your discount. It's like loyalty card only instead of coffee stamps. You save real money on every trade, so don't skip the setup. Getting your account fully verified is your first real step into the world of crypto trading, and it sets the stage for everything that comes next.
Chapter: From Bank to Blockchain, How to Fund Your Crypto Wallet Safely. Narration begins. So you're ready to deposit your money and get started. You've linked your exchange account with your bank. Great. But before you can send in that first deposit, there are a few more steps to keep things secure. Most exchanges require you to verify your identity and ownership of the account. This includes providing documents like your ID, proof of income, or a certificate of purpose, depending on what you'll use the account for. It's part of financial regulations to prevent fraud and money laundering. And here's something to note: even if you visit the bank in person, some branches may require advance notice or extra paperwork to enable crypto-related transactions. So make sure to check before you go. Once everything is linked, you'll get your own deposit code, a unique number you'll use to send funds from your bank account to the exchange. You can deposit using internet banking, mobile apps, or even an ATM. Just enter the deposit code and send your funds over. But keep in mind, after your last deposit, withdrawals are locked for 24 hours. That's a safety feature designed to prevent sudden fraud or hacking attempts. So yes, it might feel like a lot of steps at first, but every extra layer is there to protect one thing: your crypto. Chapter: Sending and Receiving Crypto the Right Way. Narration begins. You've got crypto in your exchange wallet. Now what? Maybe you want to cash out, withdraw Korean won back into your bank account. Or maybe you want to send crypto to another wallet or platform. Either way, there are a few important steps to get it right. Let's start with Korean won withdrawals. First, make sure your personal bank account is verified and linked. Then, through the withdrawal page, you'll enter your transfer amount, confirm through SMS, and boom, your money is on its way. Just note there's a fee, a minimum withdrawal limit, and most importantly a cool-down period. After large or suspicious withdrawals, the system may delay your transaction for up to 72 hours to keep your funds safe. Now let's talk about sending and receiving crypto. When depositing crypto, you don't just need the address. For some coins like XRP, EOS, or STEMA, you also need a destination tag or memo. Why? Because some wallets use shared addresses. The tag tells the system, hey, this deposit belongs to me. If you forget to include the tag, your crypto might disappear into the blockchain void. So always double check. Correct address? Check. Destination tag or memo? Check. Crypto doesn't have a customer service line. One wrong move, and the transaction is irreversible. So take your time, double check everything, because in the world of blockchain, you're your own bank. Chapter: Don't lose your coins, mastering crypto withdrawals safely. Narration begins. Let's be honest, crypto withdrawals can be stressful. One wrong digit in your wallet address, and your coins could vanish forever. No undo button, no refunds. That's why it's absolutely critical to get things right. When you want to withdraw crypto from an exchange, you'll be asked to enter the recipient's wallet address, the amount, and if required, a destination tag or memo. Coins like XRP and Stellar XLM often require these extra tags, especially when sent to platforms using shared addresses. If you forget to include it, your coins might still arrive but get lost in a sea of unknown deposits. And Ethereum, you'll need to double check whether you're sending to a contract address. Some exchanges flag these and hold the transaction for manual review. Others block them entirely. To protect users, exchanges use a system called fraud detection system. It's like a watchdog behind the scenes. If something seems suspicious, like a huge withdrawal to a brand new address, may delay or block the transaction for extra safety checks. Here's your checklist before sending crypto out. Double check the address. Confirm destination tag or memo. Watch for warnings about smart contracts or flagged wallets. And always be ready to verify via SMS or ARS before finalizing the transaction. In crypto, you are your own security team. So take your time. Slow is smooth, and smooth is fast. Chapter: Gas fees, transfer costs, and the hidden price of moving crypto. Narration begins. So now you know how to send and receive crypto, but wait, what about the fees? Inside an exchange like Bithumb, moving coins between wallets is usually